Welcome to our educational webinar series where we explore different topics to gain financial literacy and achieve financial freedom faster. Today we have Sapan Talati, and he will discuss how to identify a market out of state for investing in real estate. He has been in multifamily for over 13 years, and previously he was in strategies and operations roles in management consultant, including big bank mergers and acquisitions. In the past 18 months, he's transacted over $1 billion in multifamily, that's with a B, with over 3,000 doors under management prior to selling and repositioning. Sapan, welcome.
Hey, thank you.
Such a pleasure to have you. So, Sapan, I know you are the in-house underwriter for JT Capital. Could you please discuss how you would identify a market out of state where you could invest in multifamily or in real estate in general?
Yeah, that's a broad-based question. So, I think if I'm looking at it as an investor as opposed to an owner operator, probably have a different lens. But as an investor, if I'm looking at a state, I would probably start focusing on markets that I feel comfortable with, and so I'd want to learn a bit more about those markets. Um, a lot of sources out there available to get comfortable. And then, of course, within that, as an investor, you'd want to get comfortable with who you're investing with. So there's a whole different thought process behind that. There's a lot of good markets out there. I think I'd start with just general basic data, just to kind of narrow down a handful of markets that I might want to be invested in. And again, it depends on what level of investment experience you have as well. I think there's a number of folks out there that have probably done a lot of this, probably have experience investing in different markets with different operators or REITs or institutional capital, in general. Um, I think going forward, you want to look at market data, demographics. Where's the net growth? I'd look at jobs. I'd also look at the regulatory environment. That's changed quite a bit. We can expand a little bit on that, but those are probably the key areas that I'd focus on first before I start to narrow it down. And then within there, go visit them if you have the time. I think it's well worth understanding a bit more locally as to what's going on over there, what it looks like. It's one thing to read about it. I think it's an entirely different thing to go visit some of these markets. And then, of course, if you've identified folks you want to invest with, definitely take the time to get to meet them, ask them questions, ask them things about how they're going to manage it, who's managing it, what their experience is like, what are some challenges they've faced. Every deal has inherently some challenges on there. So no deal's been perfect, whether it's the acquisition or the operations side of it. But I think those are much more deeper dive conversations on different points. But of course, the first things first is just understand which markets you want to be in. Um, History is always helpful as well, as to how different markets have performed through different market cycles. I'm thinking of certain markets that tend to take a bigger hit during when we have downtimes in the market, and some that are able to sustain through it.
Right.
You have a lot of it like the stock market in a way. You've got your sectors. So I divide the country up into sectors. I'm just going to generalize here, but kind of the upper Midwest tends to be pretty good with cash flow as a whole. If you've held on to it for a long term, you don't have a whole lot of that appreciation effect. Whereas kind of out west, and specifically, like, I live in California, you don't cash flow, but you get to enjoy a lot of that appreciation. And then there's certain areas that it's a little bit of both, right? And so you're not going to get as much of the appreciation. You're going to get cash flow, you get some appreciation. So, again, I'm just generalizing here, but just to give you an idea of how I would diversify if I have that ability to as well in terms of different markets.
Got it. So for somebody that is new
Mm.
and they have lived in, let's say, Washington or California, where none of the properties cash flow, and they're looking for cash flowing assets, this whole wide country, how do they
Right.
start to narrow down? Do you go to a certain website to go through MSAs, and what data would you narrow down from?
Yeah, I don't know if there's any one site. I think a lot of it is just reading.
Got it.
And educating yourself. There's a lot of news sites out there. There's a lot of research sites. There's a lot of free material, right? You can Google it if let's just say we're heavily invested or involved in Central Florida. So I'm going to use Florida as an example. If you want to learn more about Orlando or more specifically like a deal we did in Ocala, you can always just type in keywords, like Ocala growth 2022, 2023, housing market. Yeah, just try different keywords to get to really understand, because you'll see the local the news and like, or you can look for development, commercial development occurring in Ocala.
Mhm.
And then as you learn and you start reading, you're going to start picking up new terms on there. Like we know it's big for warehouse, storage, distribution. So then you start
Right.
researching that. That's what I would do as an investor, especially new to an area. I recognize not everybody has that kind of time, but I think it is well worth finding the time, especially if you're investing thousands of dollars in certain markets. And then before you kind of dig in, you can always just type in like top states, top locations, top markets for 2023, 2024, or projected, specifically to multifamily. There's gonna be numerous things that'll pop up on Google, but at least this starts to help you narrow down or get an understanding or a feel for it. And then you can do your own research behind it. And so I would just use Google as a big tool as an investor, because you don't have access to the same tools that we necessarily have, where we're
Right.
pulling data off of Yardi and CoStar and some, RC Analytics and some whole bunch of other subscription sites that gives us a lot of, I think live data, up to date data that we particularly use as operators. But as an investor, without having access to that would be one area I'd start. Another is if you're already investing, I would talk to different operators and just ask them in like within their markets, why they like their markets, and they should be able to give you a wealth of information, because that's what they do, right? They
Right.
should be well aware of their sub markets, why they're investing there, and so part of that's just getting out there and talking to folks. I think stuff like this is great. Finding the individuals who are on different webinars, podcasts that can share. Yeah, at the end of the day, it really comes down to you and your comfortability. It's an example I'll use, and I know some of the bigger things we're facing is really regulatory. No one's really talking about it.
Mm.
But for example, in LA, because I live out here, the transactions have increased in costs, and part of that is just related to local municipality. The eviction costs are tremendous. Partly because while we've removed the eviction moratorium, as an example, it's still difficult to perform and do evictions. So sometimes you might have assets that a large number of folks are not paying, you're behind, you're delinquent, or you're seeing a lot of increased delinquency, and you're like, well, there's no moratorium. Well,
Right.
locally, the courts are making it a little bit more difficult to get that done in a timely manner. I know, Deepa, you're on some of our calls, and you're seeing what that process could look like versus
Right.
what it was like. Um, so some of that's related to the eviction moratorium, and different local municipalities have different updated governance on that. I think some other things related to it is, new construction is getting a little bit more difficult again. It just depends on the markets, right? So I'm not picking
Right.
anyone in your market, but these are things to be thinking about outside of just, great, this location has excellent job growth. It's got excellent demographics in terms of income. We feel comfortable with it. They've got good net migration, so we're liking the supply demand side of this, where it sits. But these other things do play a role in it. I was just thinking of some other things related to regulatory. So we talked about eviction policies. We haven't really talked about insurance. We just passed up on a deal because insurance has gone through the roof.
Oh my
uh,
goodness. Yes.
and different areas are starting to see that. Notably, I'll mention, like on the west side of Florida, right? We all know about the hurricane that hit up through Tampa. Um, we couldn't get a deal to work. Everything looked great location, excellent submarket. A good rent growth opportunity there relative to the comps. We didn't have to put a whole lot of money into it to do the renovations on it. It was, I can't get too much into it because I've got an NDA signed on it, but
Right. Right.
regardless, once I ran through the numbers, the insurance came back at roughly $650 more per door. And when you multiply the
Oh.
times per door, we're talking, well into the thousands. And so we couldn't get the return we wanted because it impacted the proceeds that we would get. And so lower proceeds, lower in terms of return on investment, and that wouldn't work for our investment group. Certainly could work for others, but nonetheless, the pricing at price point didn't work for us. And so that comes back to, we're seeing a lot of impact from the insurance side because of maybe, climate change. And so people are now, in this position where maybe they're filing for, like just insurance claims, right? And so, and I mentioned this because we're seeing an increase year over year that far exceeds the rate of inflation. We've seen probably about a 25% increase in the cost of insurance over the last 24 to 30 months. And we're still seeing that even on new deals, anywhere in the 15 to 20% range. So it depends on the market you're in, but that increase is exceeding the rate of inflation. And so when you start taking that into account, it impacts your underwriting. So as a new investor or an investor that's looking at a deal, and I know I'm just focusing on one, specific thing, but I think that kind of helps with how you may want to think about other areas of it. Okay, I see this deal. These are the returns. One of the questions I want to ask is, hey, have you validated or received a quote on your insurance? Meaning, has an insurance broker underwritten, not just gave you like a back of the envelope, insurance quote that's kind of general to the area or rule of thumb, but has this deal actually been underwritten by an insurance broker? And what's that come back? Okay, now having, being aware that has your lender had a chance to look at that and revise their quote accordingly, because that's going to have a big impact on the proceeds. Again, this just depends on the area and the market too. Like, I mentioned West Coast side of Florida because of hurricanes, the insurance has gone up significantly. I don't know what it is like out in California. There may be a different impact, but we've seen a lot of impacts due to the climate and what's going on, and the insurance costs have gone up significantly. We're seeing a lot of folks that are tapping into claims in general. I think it's unfortunate. Just owning multifamily assets, you're starting to see, not starting, but we've always had it, but we're seeing a lot more on that liability side. So these are things I think that it's well worth looking at. You don't really hear about it, you don't read about it, but we're seeing it as an impact towards us. I think the eviction piece is big. There's been a lot of delays. And so when you're looking at deals, you may want to take that into your underwriting. Again, it depends on the type of deal you're looking at. I think it's also well worth understanding how many new Class A's are coming up, because it's well known, right? We have a shortage of housing as a whole. I think the other thing is it's well known that the cost of housing has increased significantly. So, for example, to buy a house, sure, we're trying to push down the pricing. We're talking about a contraction, but the mortgage rates have gone up significantly. Where the average new mortgage, I think, is double than the rent in terms of growth, and that delta is about as big as we've seen. And so that's why we're still able to, push rents in certain markets, our market. But that being said, we also haven't seen as many folks moving in the last 6 months. So that demand, right, has dropped off. And so there's a lot of uncertainty. So I think it's a tough time if I'm a new investor to really understand different markets, because there's been so much change. And there's a lot of uncertainty and variability going forward, at least, when you think is the next 6 to 8 months. But what I would say is just start educating yourself, at least learn about the historical, kind of like the pricing historically, how different markets have reacted. And then just try to understand maybe over the next 5 years, what's kind of the outlook of that market, because I think a lot of this is short-term in terms of ebbs and flow. Right. So I wouldn't dial in on what's the next 6 months going to look like, but rather find a market that I could be invested in over the next 5 years or 10 years. I think, the buy and hold strategy makes a lot more sense versus buy and flip in 2 years, right? That's where you kind of open yourself up to additional risk. So if you want to look at it that way, that would be probably the right way. Kind of going back, we're in Central Florida. We like the numbers. We feel like the fundamentals are still very strong. We're still seeing it across our portfolio. We're not really seeing any, I would say, serious negative impact or anything that's really telling us, hey, we don't want to be in multifamily, or we should put a pause. The only pause for us is just the acquisitions and the disposition side, right? Because, we can't get the pricing we want. But that's just part of the current market conditions. We're very much a buyer. We think it's a great time to buy, actually, because, it just, there's not as much competition. And so there's some really good deals that have been coming out I would say privately or off market, that, if the pricing was slightly better, it would have made a lot of sense just to buy even at today's interest rates. We're very patient, and I think that applies to a lot of markets out there for folks who do have the capital to deploy. But that doesn't mean just because you have it, go out there and buy anything today.
Right. You'll buy some headaches if you rush into buying decisions. And you bring up a really good point, Sapan. You have to go out and get quotes, actual quotes, not rule of thumbs, because things might change. Just like you said, I've been hearing about insurance premiums that went up, and the property
Mhm.
taxes have gone up in
Yep.
some states, and a lot more than what they've been historically going up. So, and there's no way we can go out and get a quote for that, but accounting for having some wiggle room in the underwriting and not having your numbers really tight might
Right.
work.
Yeah, no, I agree. I think there's a little bit of, I think, sobering up to be had, right? Like, I think investors as a whole have to recognize we've been spoiled the last decade with returns. We're kind of seeing more of a historical normalization. So the expectations of those returns have to come back down to earth. At the same time, as a seller, the expectations of getting, kind of like that pop on the end, there's got to be a happy medium, and that's where you're going to find the best, buying opportunity, as opposed to, paying a premium for a deal in today's market. I would not at all do that. I would not want to be in a negative cash flow situation day one. I just think that that's just unnecessary risk.
Yeah.
And so, but find those deals today and finding something that's cash flowing is very difficult. I'd also go into the deals knowing that, and kind of going back to what I said, I think some of the better deals out there that are on the market that could possibly make sense are going to be ones that will require some lower leverage. So then, again, it comes back into, you're putting more equity into the deal. The returns obviously are going to be a lot lower, but the overall risk is significantly lower as well. And then you can always refinance that down the road or just hold on to it longer. It's just a little bit of a different investment thesis, but
Right.
you know, uh, the other thought process is, it's been proven over time historically, like we have inflation still north of 6%. I don't know the latest number, 6.5% or whatnot. I mean, this has always been an inflation hedge. So I still think multifamily is a great place to invest in, if it's done, I would say, in a risk adjusted manner. Right, you're
Right.
accounting for some of these variabilities. You're in markets that you're comfortable with. The fundamentals are still very strong. Again, going back to operational fundamentals are still very strong. Um, and the pricing's right. Like, the pricing takes into account the current interest rate environment. I know a lot of investors look at cap rates as kind of the primary. That's definitely not the first thing we look at. We look at what our stabilized yield is. And that's, like, for us, more important, and then our return or yield on capital. Um, but we're expecting cap rates to go up a little bit, not a lot, but we definitely see some of that upward pressure. We've seen it, but we don't think it's going to continue much more. We'll see some of that flattening, but that's just something to go in with. But it goes back to, like, can I get a 6% yield on this deal? Am I going to be content with it? Is it safe? Am I getting the write-offs that I want, which don't go into underwriting, but they do come back to you, versus going out there and investing in what else can I invest in? There's other stuff out there. Like, there's REITs, there's bonds. Some of the bonds are paying 5-6%. So maybe that's a better play for certain individuals. So there's a little bit of, I think, flexibility on where you'd want to invest, how you want to invest, how you want to diversify. But the way I would look at it is, you just got to get out there and do your own research, your own homework, and then find groups that you feel comfortable to manage your money, just like you do when you're investing in the publicly traded markets.
Right. Right. No, thank you for that. If we talk about returns on for
Sure.
a syndication versus maybe a small
Mhm.
multifamily somewhere, let's say in Texas or Florida,
Okay.
how do
Mm.
they look in the current environment, Sapan?
Good question. Tough to compare the two, partly
Okay,
because a I don't own any quadplexes
got
myself.
it.
Um,
Okay,
It's just a type of investment, right? I'm not saying it's a bad investment. I'm not saying it's a great investment. I just couldn't compare the two.
right.
Um, I think the way, and I do own some single family homes from a long time ago, and so I can I'll derive my answer off of some of that. We have different expenses. We have to pay a lot more attention to those single family and duplexes, where if we lose a resident, it's vacant.
Right.
I think the write-offs are significantly different. I'm seeing we have more write-offs if we go through the multifamily route because we can do cost segregation, we can accelerate the depreciation, and that's meaningful for for investors. Not all investors,
Right.
but it's
Right.
it's meaningful for the investors who can actually apply that write-off, or maybe today, or they want to bucket it for they're expecting the ability to use it over the next few years, right? And again, that's an accountant question. I think with quadplexes, it's not bad. It's just a different form of diversifying, your investment. I like multifamily because I feel like I'm putting the same amount of effort and time into it versus if I'm looking for, say, a single family. Um, but I also like single family for investors who have the experience and have a team, maybe have that broker relationship to go out and find that. So I mean, I can't really compare the two. I think they're just totally two different types of investments. I don't think there's a particularly right or wrong as to which one would you choose. It just comes down to, where you feel comfortable, where you'd want to invest, and then if you already have a pre-existing team, I think that in and of itself is a big advantage. Um, and we had talked about some of the advantages before of being
Right.
in multiple markets versus zeroing in on one or two markets.
Right. And I agree. Also, just doing our research in the front
Mm.
end and doing market research about job growth, population growth, median income, and supply and demand, like all the things that you talked about, and zeroing in on it and just going there maybe at different times of the year, different times of the
Mm.
day, and driving around and just finding those pockets. Like we talked about, I think this was offline too, but we talked about just pockets, good pockets, and maybe 2 blocks from there might not be where you want to buy an asset. So just
Sure.
driving around and knowing in person, um, there's no replacement for that.
That's right. Yeah.
Agree?
If
Yeah.
I may, like example I'd use, I think it was during our retreat, right? There was a deal that you went out to with the team, right? I think with Puja, and you guys were driving into it, and the underwriting was great on the deal. When you're
Right.
driving through, going into it, your first thought would be, "Oh my God, we don't like this area. It doesn't look
Right.
good." And then you get there, and it's just like, wow, this is amazing. And then you're going out through the other side, and you couldn't see that on a report that did a 1 mile radius and a 3 mile radius because you're now including things that wouldn't necessarily impact the actual investment or the asset. And then again, how do you know if that 1 mile radius search, like which ones do you deselect and include? Like you wouldn't
Right.
know that unless you market, right? And so I
Right.
think there's a lot of intangibles with that in terms of understanding and knowing your market. Now, if I'm an investor, I might not need to know that level of detail. My expectations would be the sponsor or the GP that I'm investing in um, has that ability, right, to ascertain is this a good investment or not based on some of those other variables that come in play.
Right, right, got it. And one of the investors who asked the question about the reason we are putting this webinar together today is I had a conversation with him about the returns overall for a syndication versus the return from a small multi. And the return from a syndication, now the numbers have changed, but overall, the multiple would be 1.8 to 2.0. That might have come down now because of the interest rates. But thinking about the houses that you own,
Yeah.
thinking about the overall life cycle of owning a house, over
Mhm.
30 years, you don't pay even a single mortgage. Hopefully it was occupied, just FY, just let's assumption.
Yeah. Yeah.
If it was occupied the whole time, um, you now own the asset without paying anything for it. But was
Mhm.
it worth your time? And what were the expenses? Maybe during that 30-year whole time, there was a roof that needed to be replaced, or the septic system needed to be replaced, or something like that. So
Yeah.
Thinking about
I
all that,
think,
sorry, go ahead.
yeah. Oh no, go ahead.
We just have to
Uh,
think about this whole thing to see if it's really worth it, comparing, a syndication to holding asset by yourself.
sure. I think if I'm investing into a syndication versus, if I understand correctly, versus buying and managing my own on a smaller scale, it, it comes down to what type of investor you are. If you have the time, number one, then you can explore the single family or the quadplexes, triplexes, or small multifamily because that's time that you have to put in. Versus if you don't have that time and you want to invest, then maybe the syndication route, a REIT, or investing into a group that's actively going out there and buying multifamily on a smaller scale. But again, at the end of the day, if that time you don't have that time, then you become an investor. So then you have to just kind of put on your investment hat and think about which one of these, has the best, I would say, risk adjusted return for you. Um, and if I have the time, I can continue going and do this. But then I'm also an investor. Do I want to reinvest my money into this, like into myself, or do I want to diversify that out? And if I diversify that out, what does that look like? Is it finding other folks that are doing exactly what I'm doing? Or is it investing into multifamily?
Mhm.
So those are questions I think you just have to ask yourself as to
Right.
where you're more comfortable and what you're looking for.
I love it. You're like, what kind of investor are you? Do you have the time? Um,
Yeah, because I mean,
right.
I'm biased, right, towards multifamily because I've been doing this for a long time. But that's not to say I don't invest outside of multifamily or in other areas as well. So I think it really just comes down to the type of investor you are and where you're most comfortable.
Right.
There's a lot of data out there. I think one of the most commonly ones that you'll come across is just multifamily as a whole. While it won't have sometimes the glamorous returns of maybe new construction, new development, but it historically has had the best, consistent risk adjusted returns. So it's viewed as one of the lower risk real estate investments out there. But then, cyclically, we have different areas within real estate that do outperform multifamily,
Right.
and then multifamily will, be in the top three. So it's not to say outperforming, but it's a very comfortable, place to be. So I think that also just comes back to researching and seeing where you're comfortable. That I think development for the right type of investor could be exciting, while understanding what that could mean 2 years, 3 years down the road. Right? There's no cash flow day one or day two. Year two, year three. Are you comfortable with the uncertainties? We don't know where interest rates are going to be. We don't know what the take rate is. The regulatory environment, as I mentioned earlier, seems to be changing pretty quickly, and in some cases, it's adverse to new supply, even though we have a need for new supply. Again, that depends on the market you're in. I think we're looking at new development activity. It's at a low for this year, which means
Right.
if we're assuming 2 years for development completion, that would mean new Class A 2025 is probably gonna be at that supply, coming out to market is going to be at a low. So those are some things to think about. We're seeing costs coming back down, at least for the development side. So, I think if you have a development team that's been doing development, they know what they're doing. I would say that's a good opportunity. Look
Right.
into it. If you're new to development, I would say don't touch it.
And there's no depreciation, right? They're
No
new.
depreciation, correct? Yes,
The tax benefits of a syndication are not there. But
right.
like you said, for some investors that might be exciting because they don't know how much they're gonna make. It might be a lot more than what the pro forma suggests. So
Yeah, and we're in those times right now where if you buy a deal, you can't go into it expecting a lot of cash flow. Um, if I use, say, I think kind of the gentleman asked about the quadplexes, he could probably answer his questions better than I could, but I'll draw on mine that I bought a long time ago. It's been about 10 years, and we're cash flowing tremendously, but we didn't have that cash flow right away. It took some time, and I think with multifamily, we're able to force, appreciate, and create some of that cash flow a little bit quicker.
right.
Uh, Notably, I can talk about the stuff we're buying. And so, I don't want to speak for other operators, but at least from our own experience, we've been able to very successfully find deals that the average, I would say rent, is anywhere from 250 to $300 below market. And so just by bringing it up to market, not doing any more, right? Just bring it up to where market is, and
Right.
then multiply that times the number of units, you're able to very quickly increase cash flow, and get to a point where then you can, enjoy some of that cash flow while also getting that cost segregation. So you're getting that immediate, yeah, first year depreciation, whereas we couldn't do that on our single family. Now that doesn't mean it's single family or the small ones are the wrong play. I think there's a lot of folks that are doing it. Even some big names like Jeff Bezos started a company where that they're buying a bunch of that stuff. So there's a lot of opportunity there. It just goes back to the amount of time you have. Not only if you want to be actively pursuing it, but then secondly, can you do the research and understand where you're investing? Because I think a lot of it really, it's not rocket science. I think it just comes back to effort and time, available to you to go ahead and do that and
I
execute.
agree. I agree. And how much and what kind of lifestyle you want. Is some people
Right.
like to be busy, right?
Right. Yeah.
And have more control. So for them,
Right.
the small multis will give them a lot of control. And if you value a time a lot more and don't want to be busy, just want others experienced management groups to take care of all the headaches while
Right.
you get distributions and monthly reports. I agree. Thank you.
Yeah, and one thing I'd add is if you're doing those small multis out of state, you need to have good systems and processes in place. Right? It's a lot different if it's local, where you yourself can go out there and do it and you enjoy
Right.
it. I mean, eventually you're going to develop the systems and processes locally. A little bit easier to pull those resources, but out of state, a lot more accountability. You need those systems, you need those processes, you need to have resources in the sense of like, what happens if my manager just ups and leaves, or what if, like
Right.
we lose a tenure or two? How are we going to quickly replace that? I just think that there's more that needs to be thought through, which
Right.
kind of goes back to like how much time do you have
Right.
to kind of dedicate it. All of these things are businesses at the end of the day, right? You're basically creating a business, and
Right.
you have to be involved.
Right.
Um, Even if you find a good property management team, you still want to be involved and engaged. I'm not a fan of the folks out there who basically hand keys over to property manager and then don't look at it. There's a lot of expenses that I feel are inflated, and you're not going to be aware of that unless you're
Mm,
engaged and well in tune with what's going on. And right now is a good time, as any, but you really want to be making sure you're keeping your expenses in line and as minimal as possible,
right.
especially given. Um,
So, Sapan, how much time do you spend on your rentals on the single family? Maybe just one of them, and how do you
yeah,
catch those expenses if they seem inflated to you?
sure. Fortunate for me, I have a partner that
Okay.
really enjoys that. So I have not had to do that, but occasionally I will look at it and I'll just compare, just to make sure that we're in line. So, when we're doing renos and stuff like that, I'll get involved a little bit, but that's something he really enjoys. He spends a lot of time. He's been building that smaller multi and single family portfolio of his own. And so the few that we have together, he's been largely managing it. So I've been lucky on that side of it.
Very lucky to find a good property
Yeah, there was. I
manager.
honestly would have sold them a long time ago because I don't have time to be active in it. I spend my time at JT, and anything else I do outside of that is just purely investments.
Got it. Got it. I know it's very, very important to find a property management company. I've heard so many horror stories of people stealing money from the owners and misrepresenting and even creating fake documents of work
Yeah,
that was never done and not paying vendors. And ultimately,
yeah.
you're
There's a lot of horror
on the
stories out there.
blacklist.
Right.
Yeah. Yeah. So we have to be because we are the owners and the property manager until maybe unless we give them equity, you know, just
Right.
give them some equity and make
But
them
even
part
then,
owner.
right? It's a tough. I think it's tough. Like that. That's why I'm a big fan of. If I'm buying that stuff, I want to be involved. I just feel like you need to be. There's a lot of moving pieces with that. Because one, you can't afford to hire unless you have a larger portfolio. You can't hire a full-time on-site community, manager. You're talking about a
Right.
duplex, or you're talking maybe 6 or 7 units, and so
Yeah.
you need somebody to manage it. And that person's not going to be on site. They're
Full
going to
time.
be. likely a property manager that's managing many other properties.
Right.
And so what happens at night, is this property manager able to address concerns at night or not? Like, there's just too many, I feel like, moving pieces for my comfort. But again, that's because I'm in a different area and I'm spending my time there.
Right. I agree. No, thank you for that. You bring up a good point. For larger multifamily, the property kicks off enough cash flow that it can afford to hire a full-time staff, security manager, leasing agent, maintenance people, technicians, and grounds for some attempts to clean grounds if needed.
Right.
But smaller multifamilies do not throw
No.
enough cash out to have a dedicated, even one person, um,
Yeah.
for leasing or answering questions. It might not need, it does not really have enough time or enough work for a person to do it full time. But
Mhm.
when it's needed, you really need it now. If there is a pipe that breaks or something happens, then it needs attention um, now. And that
Right.
person, the property manager, has to be available to address the issues.
Correct. Yeah. Yeah. No, and I can't speak too much to this side of it because it's out of my wheelhouse, but
Right.
I'd imagine the costs are going to be different, right? Like using your pipe burst example, um, you know, with our property management company and then with just the volume we have, we get discounts on a lot of our supplies, especially if
Right.
when we're doing renovations. Whereas you're not going to get that same, on something smaller. Um, but I think there may be a lot of cash flow opportunities on that because it's the same thing. Like we're having a tougher time finding a deal that works for us, right? We can easily go 6 to 8 months without having a deal because we're patient. I think on the some of the smaller stuff you're gonna find, and I'm just thinking about this opportunistically. There's probably owners out there that had some pretty bad, high leverage floating debt, no rate cap, for like these duplexes, quadplexes, 6, 7, 8, 9, 10 unit deals that could be well located, really well positioned, and maybe even a ton of off market opportunity. Again, coming back to if you're able to or have these pre existing relationships or able to create these where you can get excellent pricing and with some effort, right? Just get the right crew in place to manage it. But again, your cost basis is so favorable; it could very well cash flow from day one. So I think there's a lot of opportunity in the current market cycle for either side. I'm just trying to think of the folks who are looking for this. Um, but again, it comes back to you have to have the time in order to do it. You can't just be an
Right.
investor, otherwise you're not going to be
Right.
successful doing that.
And you need to have a little bit of experience to know what to look for.
Correct.
Right.
Yes.
Yeah.
Yeah.
You look at the sea of numbers on the spreadsheets and you're like, oh my God, everything. I don't know
Yeah.
what's what.
Right. Right. No, but those are the folks that just won't have that war chest. Like I was saying, fundamentals for multifamily are strong, right? Like some of the larger assets, um, we're not really seeing anything I should say, we're not seeing distressed assets in general, right? The ones that we're seeing that might be coming to soft markets because a group just happened to be unfortunate with no rate cap or an expiring rate cap, or they had floating debt and that debt's expiring, and so they're kind of facing a
Mhm.
high interest rate on a refi with a big cash in situation. Again, they're not distressed assets; they're just becoming forced sellers because they just can't get the right debt instrument in place.
Right.
Uh, right? That doesn't mean they're not hitting their pro forma. Right? And so, kind of comes back. Fundamentals are strong, but we're not seeing that distress situation. And in some cases, larger groups have the war chest to kind of offset some of the interest rate pains, the short term pains that they're going to feel. Whereas you're talking about a mom and pop that owns, say, that 10 unit multifamily in a great location. Hey, they may have done a cash out refi because the market 2 years ago was great for that type of refi. We got all this equity out and we got great debt. It was really low leverage or high leverage, low interest rate, maybe like sub 3%. It's floating, but no one expected this. And now all of a sudden they're in trouble. They may be like the right seller because they've already made their money. So they may be willing to sell that asset for a little bit lower than what they would have liked, but they still made a
Mhm.
handsome return. And so I think there's a lot of opportunity in that because there's going to be more folks that probably have some of those challenges. Again, it's not my market, so I don't know where in the US people would want to focus for that. But I think going back to just the key things. Good income demographic, good net income or net flow of migration patterns. Notably, we're seeing a lot of that going to Texas and Florida.
Right.
I look at housing costs as a whole. I think we're expecting a significant not depreciation, but just deceleration and kind of coming back down to earth pricing, at least out in Arizona and Nevada. So some of those markets I'd be cognizant of if I'm still buying single family, because you want to take that into account. So you're not underwater day one. But just different research, and then go talk to brokers. They give you so much information.
That's a good point. Yeah. So Sapan, how do you recommend somebody go talk to a broker? Just call, if you call them up as a small investor, they
Right.
might,
Well, family's different. Like
yeah,
that.
they might pick up your call. I'm
No,
not.
I'm talking about if you're in that single family side, right? Because you
Got
are
it. Got
you are
it.
the target market. But if you're for multifamily, I wouldn't recommend talking to a broker unless you have experience in what you're doing, because most of them are not going to want to spend time on the phone with somebody that's just an investor.
That's new.
In
Right.
general, they don't have the time, and
Right. Right.
I
And their time is all commission based. And as an investor, and especially smaller properties, it might not be worth their time.
yeah, but no, what I would do is talk to the sponsors out there, the GPs that out there. That's who I would talk to,
Okay.
because they I imagine are living, breathing it. Should be able to help you with the markets that they're in, because you're interested in those markets.
Right, right. Got it. Sapan, thank you so much for your time. This was very, very informative. If people want to reach out to you, what's the best way to get in contact with you?
Yeah, sure. They can email me. If you want to give my email out, feel free.
Okay, sure.
Set some time to chat, or if they just want to email me questions, I'm happy to do that as well.
Okay, could you please give the email out here?
Sure. It's just up in at jtcapitalgroup.com.
Thank you. It was a pleasure, and hopefully we learned a lot, and hopefully it was good worth for your time to spend here with our investors. And I know you're sick too, so guys, Sapan has a head cold, but still made the time to be here. So Sapan, thank you so much.
Sure. Of course. Thanks so much, Deepa.
Bye.